pretty phenomenal returns.
We want to get an ISDA agreement with JP Morgan so we can deal in long-term options.
That's really cool. That is so cool.
Thank you.
But you guys are under the capital requirements for an ISDA.
By how much?
How much? 1,470,000,000. So, a lot.
This makes us look bad, doesn't it? That we didn't know what the capital requirements were?
It's not great. But keep up those returns and give us a call way down the line, you know? Okay?
Okay.
Okay.
Thanks, Chris.
Have a good one, guys.
Thank you, Chris. What?
So you can't get an ISDA? Well, the only other option, no pun intended, is to get options. On Friday, October 28th, in the pre-markets, right here, the markets surged early morning due to what? 6:30 in the morning, personal income, significantly higher than consensus and forecast. That sent the markets skyrocketing, ending the day almost 830 points, or over 830 points, I should say. On that particular day, I had call options that I bought the day before, and that got me 115% gain in a single day. Now, that leads to today's presentation. How do I know what call strike price to select? Okay, that is what I'm going to review with you guys today. Now, before I do that, let's just quickly, in the next few moments, discuss how did I know to get call options the day before Friday, October 28th. If you've been watching my videos, this is the 1 hour chart. This is the MACD of TQQQ. And you remember the 1, 2, 3 count? 1, 2, 3, create the notch, surge. That's exactly what happened. And as I've been saying in previous videos, the day before, it was the night before, in this case, futures were down, were going down. That's actually a good sign. Going down, even though the MACD was creating the notch, the next day, early morning, it already started going back up, and then it surged. They already knew what was coming. The big boys already knew what was coming, and they used their little ISDA agreement, which I also coined, legalized insider trading, to actually place those trades ahead of time. Okay? So, let's get into it. The strike price. Now, for now, I'm going to just get to the net, and then I'm going to get into the details, okay? The net is just select near at the money strike prices. So here in the center is your strike price. Let me zoom in on that so it's just bigger, easier to see. Here's your strike price. Okay? Now, this on the right side, I'll zoom back out and I'll also show some other slides. Right now, on the right side, you're looking at the put options side, right? So you want to short it. In this example, is TQQQ, the option chain as of Friday, end of business. Okay? So let's just hone in on the at the money strike prices right here. It's basically $20.50, $21 even. Okay? And I'm going to go over, since this is a basic options session, I'm going to go over, you're going to see another slide where it's like, what do you mean at the money? You know, I'm already throwing out terms you're not familiar with, okay? But for now, I'm just going to get to the conclusion. Basically, you're buying at the money because and again, you're going to see more slides of this, because at the money strike prices have the highest gamma, but unfortunately they also have the highest theta, which is time. Okay, they have the highest gamma because they are more short-term related. Just kind of know that. So there's basically delta, gamma, vega, theta. Okay, but for now, just kind of keep a mental note that I'm talking about the gamma side. Okay, you're going to hear things like gamma squeeze and all that kind of stuff. Okay, now here's the net once again. So this is at the money. I basically I choose the strike prices that have ask bid spreads of 5 cents or less. Typically, I don't mind going up to 6, but I prefer not to get into 7, 8, 9, 10. Okay, the spread is too big. The spread is too big because when the spread is smaller, right? Well, then that means you don't have to wait as long for to sell at the bid price, right? But if the spread is bigger, you have to wait longer. You just have to wait. It forces you to wait longer to get to break even. Okay, when the spread is too big. Okay, so in this situation, $21 is most definitely preferred over $20.50. Not only because the spread is smaller, only a 4-cent spread, but when you look over here, this is actually a significant difference in like a 40% difference, like right, the difference between 8 cents and 12 cents of a gain for that option contract is 40%, right? That's a 40% difference. But the difference between the what is this here? Okay, the ask price. Okay, the difference in the asking price is not 40%. So that's another reason. It's a 40% difference, 12 cents over 8, but that's not a 40% difference between the ask price of the two strike prices. Okay? Another reason, look at the open interest. Clearly outweighs 4,200 compared to 935. It's a no-brainer. You take the $21 strike price. Okay? Take the $21. Now, that's basically the net, right? That's the conclusion, okay? And now I'm going to get into a little bit more of the details. Okay, so time to profit between a traditional investor and a day and a swing trader. Okay, now actually before I get into some of those details, for you newbies, which is what this video is meant for, it's not really meant for you seasoned options traders, guys. In fact, I would encourage you seasoned options traders who are listening to this, please comment. Also, to just share your experiences, share your perspectives, because this is meant for the newbies. This is not meant for you seasoned guys. So it's not meant to insult your intelligence by saying things you already know and use every single day. Okay, so left side is calls. This is the option chain. Left side is calls. Right side are puts. Okay, now I'm going to show you another slide, but see this shaded area up here? That's in the money on the call side. This unshaded area is out of the money. Okay, on the reverse, this is the shaded area on the put side, meaning you want it to go down. You want the prices to go down. That's why it's shaded down here. This is out of the money up here. Okay, so at the money is right there. It's the transition between shaded and non-shaded. Okay, that's the simple and basic definitions there. All right, so traditional investor. Now, obviously traditional, they're willing to wait weeks, months, whatever, right? They're kind of buy and hold. They don't mind. But even if you're a traditional investor in options, you're typically still going to be slow. You're willing to sit on. You're willing to buy expiration dates right here, way out, like weeks, months out. Okay, whereas I don't. I usually go at most 2 weeks out. At most 2 weeks out. Okay. In this example, it's a couple weeks out. Okay. So, swing traders, you're faster. You want time to profit. Okay. And earlier I mentioned weeks, months, expiration date, hours versus days expiration date. You know, I know you SPY traders out there, they have daily expirations. That's super, super short. You want to talk about long date versus short date? Yeah, you go look up SPY's option chain. So, okay, premiums though. Premiums for longer time frame. Oh yeah, much higher. Easily double. You know, you want to buy something 3-4 months out, you're paying 2 times the premium. Think of it exactly like paying insurance. You want to pay insurance for 2 to 3 months out. Well, that's going to cost you more, right? Car insurance versus, no, I just want to pay for this month. Okay, well, that's going to be a lot cheaper, right? So, same thing. Premiums are much higher, premiums are lower. But you know, there's nuance to this. There's nuance to the premiums, even on the lower side of the day and swing trading options. Depending on how in the money, how far up in the money you go. Look at the ask price, for example. Look at this call, 605 versus at the money, $1.68. See what I mean? So even within a short dated call option, you can, if you go too high into the money, your premiums do get higher. Okay, so there's the goal. I went to the net right away. Usually, if you're a longer term investor, you're gonna want to be more in the money in the long term. But short term investor, day swing trader, you want to be at the money or out of the money slightly, or even slightly out of the money. Like right here, 6 and 6. That's technically out of the money. But as you see here, it's still profiting. Okay. So, ask bid. Yeah, the spread is going to be higher on more longer term investments, but it's going to be much lower on day swing trade. Okay. So earlier I mentioned the gamma and the theta. Now, for longer term investors, I'm gonna hold off on explaining too much. The next screen shows you, it's gonna give you a visual, but at the money is going to have much of the highest gamma. The further you go into the money, the further you go up in this example of calls, the further you go into the money, the lower the gamma. Okay, gamma is what is the gamma squeeze is what people call the short squeeze, where you have short-term put coverings, right? You're covering your puts, like when all of a sudden the market rips the other way and everybody's got puts in. They're like, oh crap, they're getting gamma squeezed. They're getting gamma squeezed the other way. Okay, so that's why people, traders who buy options at the money are basically buying high gamma options. Okay, yeah, the day trader, the gamma and the theta is higher, but yeah, the gamma is higher and the theta is higher. Theta is time decay, because you are choosing short-term expiration dates, right? Not long-term. Well, the time decay is also higher. Time is against you, right? The clock is against you. You have less time, so you have less time that as would a traditional investor. Well, I've got all kinds of time. I've got 3 months out till mine expires, so my time decay on a 3-month expiration date, no problem. It's not decaying that much, right? So while you have a high gamma, you also have a high theta. Okay, just know that. That's really all you need to know. Okay, and typically the gamma is highest when it's closest to the expiration. Okay, for at the money. Okay, so obviously gamma risk is lower for long-term investors, much higher, much higher for short-term investors. Okay, now margin of error. You have, as a traditional investor, longer term, 3 months, 4 months, 5 months, 6 months out. You could be 6 months out, buying options 6 months out, and therefore you have a larger margin of error. You're like, I don't care about the day-to-day swings. I got 6 months. Okay, you have a larger margin of error. Low gamma, low theta. But day swings traders, oh no, your margin of error is much, much smaller. Much smaller. Okay? Now, I have seen, however, some stocks channels, they do day trade and swing trade options, but they intentionally take larger expiration dates. So what that means then is, oh, okay, to me it's two-pronged. When you even though you're swing trading options, but you are choosing a longer expiration date, that says two things to me. It's going to tell you, number one, I want a larger margin of error in case I'm wrong, right? That's what it means. It's like, I'm on the wrong side of that trade. I've got longer before it expires for it to come back. Okay, so that tells me I want a larger, margin of error. But that also, the second thing it also tells me is you are willing to accept a smaller profit, right? It's a smaller profit because you have a longer expiration date, therefore a lower gamma and a lower theta. So you're willing to, even though you're day trading, you're willing to accept smaller profit from a lower gamma, right? Yeah, so you're willing to accept smaller profit and you are acknowledging that you want a larger margin of error. Okay? So I hope that makes sense. Let me know if it doesn't, and I will explain more. Okay? All right. Yeah, this slide here is pretty okay. Let me just explain it at high level. Left-hand side is basically the expiration date of December 23rd. Right-hand side is December 30th. Okay? So, what you just saw on the previous slide, I circled it right here. That's the $21 and $21.50. Okay? Strike price in the middle. See that? There's the gamma. There's the theta. Same like on the put side. On the put side of the December 23rd expiration on the put side. But then you also have gamma and theta on the call side. See that? So there's the shaded region, right? There's the shaded region, right? That's in the money. That's out of the money. That's at the money, right? So ITM, in the money, at the money, OTM, out of the money, right? Same on the right side. OTM, out, at, in. Okay? So, and then, earlier you on the previous slide, you saw which one of the strike prices were definitely more valuable, and that would have been 21. Okay? Now, okay, so let's just kind of zoom in a little bit because it's just kind of small. Let's go calls first. So here's at the money. At the money. The delta, I didn't really talk about that. I'm just going to say that it goes up because honestly, if you're short-term trading, you need to worry more about gamma, which is this column. This is this column. Okay? Notice how this is deep in the money, right? This is the call side. Deep in the money. Look at how low that gamma is. Look at that. 0.004, right? At the $12 strike price. 004. Let's go to the $20.50 strike price on the gamma. 0.1. Significantly higher, right? There's no question. Okay? So, that is an example of that. That's why the arrow goes this way. At the money. It is highest at the money. That's the gamma squeeze. That's the gamma squeeze I'm talking about. So all of a sudden, millions and millions of options are bought at the money. Oh, here comes the squeeze. The bears are about to get short squeezed in this case when you're talking about calls. Okay. However, here's the theta column, time. Look at time. So here at $12, it's 0.003, right? Look at the $20.50, 0.05. So it's a significantly larger time decay, time subtraction from the value, right? That's how options work. So what you get with the good, high gamma, highest gamma, in fact, you also get the bad, highest theta, highest time decay. Okay, that's just that's the takeaway that I want you to get. You get a lot of horsepower, but you also get a lot of time decayed. Right? Okay, so yeah, that's basically what I showed you earlier. Now, okay, here we go. What I didn't show you earlier here, here this is the $21 strike price is the ideal one. Look at, here's the gamma, 0.1121, 0.1123. I guess I circled these two when you're comparing, not only because 21 is ideal because that's a much smaller ask bid spread, 4 cents, right, versus 8 cents. But the gammas are essentially identical. See, they're essentially identical. And here's the theta, essentially identical. That's why I wanted to circle that. Okay, so all things being equal, gamma and theta being equal, well then you got to go with the lower spread, right? You got to go with the lower spread. But then also, look at the open interest, see what others are doing, right? Okay. So once again, this is the put side of the December 23rd expiration. Once again, look at the. So here's the gamma, right? Ooh, I hope I didn't draw that arrow the wrong way. No. That's correct. The gamma is the highest. It's high. It's a higher number. Negative 0.48 is a higher number than negative 0.99. Oh, I'm sorry. Actually, this is the put side. Oh, I think I did draw it the wrong direction. Oops. So anyways, okay. So it's the same concept though. Gamma is highest. No, that's actually correct. That's a higher number. It's a negative side. Gamma is highest. Theta is also higher. Yes. 0.05 compared to 0.002. Okay? All right. So that is December 23rd. Now, okay, so here's December 30th. Basically, okay, let's just look specifically at the $21. Okay, see that? Let's just hone in on $21. So the ask is $149 for December 23rd. $21. $21 for a week after that, December 30th, is 166, right? 166 is obviously greater than 149, okay? So that makes sense. You want more time. The premium, the ask price is going to be higher. That's just the way it goes, period, okay? For the same strike price, okay? And I'm willing to bet, even though I didn't circle it here, 0.0992, right? The gamma is lower too, because you want more time. 0.112 on the 21 on the gamma. 0.099, yeah, it's lower. So the gamma is lower, right? Gamma, and therefore the theta is going to be lower too. See, so that's what I meant when I was talking about earlier. I said, well, if you want longer dated options further out, then you're willing to accept less profit, right? Remember I said it means two things. You're willing to accept less profit because you have to, because it's less gamma, because you're further out. And not only that, your premiums are more expensive, right? So it's less profit. But you get some insurance back by having a larger margin of error. You have more time. So you can recover, right? That's a larger margin of error. So it's up to your risk tolerance, right? Risk tolerance and your objectives, maybe also your budget, right? So let's get into the next slide that covers that very topic. Okay. Short dated versus long dated. Yes, long dated is on the left side, short dated on the right side. Long time to profit, Short time to profit, right? Makes sense, left and right. Low risk tolerance, high risk tolerance, right? High upfront premiums, low upfront premiums, right? In general, right? You want more time, that's going to cost you. Just like you pay only 1 month of insurance versus 6 months of insurance, that's a difference. That's pretty difference in price, right? So, but also I also mentioned earlier, remember, even within a short dated option, this say December 23rd, the higher you go in the money, the higher the premiums go too. Okay, so low doesn't necessarily mean absolute low for everything. It depends on how high you go into the money also. Okay, so long dated means I just want more margin of error. And maybe that's what you can do if you're a beginner. Just like take one option contract, right? Take one. I'm going to go back to the first screen and maybe make a recommendation. And then obviously short dated, low margin. It's like if the trade goes the wrong way on me, I don't have a lot of time to recover. If I recover at all, your option might expire worthless. Okay? All right. I mean, I guess I didn't even mention that at the beginning. Boy, if you're taking high gamma, short dated options, like when you're trying to day trade, and it goes the wrong way on you, or you could lose your shirt. We're talking about in a matter of seconds, not minutes or hours. If something happens and it just goes the wrong way, it doesn't matter what the reason is. You miscalculated, something happened in the news, whatever. Whew. In a matter of seconds, you could be down 50, 60, 70%. It can happen that fast. Okay? So that's what I want you to keep in mind for you beginners. Okay? So let me get back. Yeah, I want to get back to this one. Okay. So this is TQQQ as of Friday, right? If you're beginning and you just kind of want to start out, let's just rewind. It's Thursday. Well, we all know that this past week was a big down week, right? So let's just go back to like Wednesday when it was definitely going down. Okay, let's pretend it's Wednesday. This is the option chain for Wednesday. Okay, and you're like, yeah, I think I'm gonna short this. It's just not looking too good right now. So as you see here, let's just look at this $19 one right here. The fact that the change column actually shows a plus 5%, it's actually already in the positive. I can tell you already that you would have been profitable within several minutes if the market was falling the way it was last Wednesday. You would have broken even and been in the positive. That's why it's showing this as positive. Even though it's technically out of the money, oh no, you would be in the money within minutes. Like I'm talking 5 to 10 minutes. Just depends on how fast the market's falling. Okay? And the ask is 68 cents. So just take that times 100. It would cost you $68 with a little bit of the option fee, right? On top of that, it would have cost you $68 to buy one contract. And so, that may not be a bad way to kind of get your feet wet, kind of get a feel for it. Like I wouldn't be buying, don't until you start to build your dexterity and your confidence. Maybe just buy one contract. It would cost you $68 and some change for the trading fees and whatever, and then just see how you do, right? As you get more confident, obviously you can start to buy more and more contracts. So that's my general suggestion to you. Let me know, if you guys have any questions based on what I have said today. Again, experienced options traders, please feel free to leave comments. Give us your experiences. Give us your feedback. What do you guys like to do? I mean, basically, today I just showed you what I do, you know. So, and with that, that's all I've got for today. Feel free to follow me on Twitter, where I post real-time updates during the day. And if you liked today's video, please give it a like, share it with other traders, subscribe, or click to be notified. And I am Agent 000, the Wolf of Wall Street, signing out.